This is Sovereign Debt, a podcast on greening the global economy and debt sustainability. I'm your host, Jill Doshi. Hello, everyone. So today we are joined by Jeromin Zettelmeyer, who is well known to many of us from his prolific writing on sovereign debt, as well as his current position as Deputy Director of the Strategy and Policy Review Department of the International Monetary Fund. But sadly for us, he will be soon leaving the fund, as he's just been named the incoming director of Bruegel, the economic think tank based in Brussels. So, Jeromin, first of all, thank you so much for being with us today. And also congratulations on your new position.
Thank you so much. That's why it's so important that we're doing this podcast, because this sovereign debt stuff is so arcane that I'm sure I will forget it within the first 3 months of joining Bruegel. Then I can go back to the podcast and remind us.
Excellent. Let's record all your wisdom now. And exactly, some of what you have been working on most recently is really getting into the weeds of the policies. And it's one of the major things I want to talk about today in some detail, because you've just published a paper and the board has just agreed it, a policy review and updating of something that's been going on for actually several years, if I'm not mistaken. And that's regarding all of the arrears policies of the IMF. To kind of get us started, I just want to name kind of what I understand to be the three major kind of arrears policies that have been the subject of all of this work and scrutiny. And that is what we call the NTP, so the non-toleration of arrears, and that's to the international financial institutions and official bilateral creditors. The second is the LIA policy, which is your lending into arrears policy, which is to private creditors. And the last is the LIOA, which is the lending into arrears to official bilateral creditors. So first of all, just before we get going, do I have that part straight? those are the arrears policies.
That's correct. So those are the policies as they have historically evolved into these three pieces. And what this review does is it reviews all three, and it also reviews some definitional issues, basically to help us decide which type of arrears we slot under which policy. So that's the so-called perimeter question. So, part of the reason why this is complicated is because in the olden days, there was just one policy, which is the fund doesn't tolerate arrears, period, right? So there was just the non-toleration policy, and it applied to all creditors. This reflected basically the view that we didn't condone arrears. We thought arrears were a bad idea under any circumstance because they essentially reflected rogue debtor behavior. And remember, this was from a time, until the, I would say, early 80s, when very serious people, including in the markets, believed that sovereign defaults were essentially impossible, right? Were a thing of the past, and so that any
were they wrong?
right, exactly. They were negating the basis for your trade, Jill. Now, I mean, they didn't think that they were impossible. They thought that they were always unjustified, right? So there was a belief
unjustified. So a sovereign should always pay all creditors.
Yes, and the reason was that there's a famous quote. I forget from whom. I think possibly from the chairman of Citibank at the time, from the early 80s, saying something to the effect that sovereigns cannot go bankrupt. And the reason why sovereigns cannot go bankrupt is because they have the power to tax. So if sovereigns pretend that they are insolvent, it must be in bad faith, right? So that was essentially the prevailing philosophy, because people had forgotten, 200 years of sovereign debt crises and restructurings. And indeed, there have been almost nothing going on in this area between the sort of big settlement of the 1930s defaults in the late 40s, and then, a few isolated cases in the 70s, and then bam, we got the debt crisis in the 80s, right? But so this non-toleration policy comes from this time when basically the fund assumed that defaults reflected bad faith on the part of debtors, and hence they were not tolerated. And then, we went into the debt crisis of the 1980s with this philosophy, and it didn't really work, right? And this is when the fund got into trouble with civil society, with development countries, for being a quote-unquote debt collector for the banks, right? Because, of course, what happened is that if we tell a member, you may be in trouble, for exactly the reasons or in the type of trouble that we are mandated to assist you with under our articles, namely a balance of payment problem that should be resolved by some kind of mixture of financing and adjustment over a period of a year, maybe a few years. But we are still not going to help you because you are in arrears to your creditors. So this became sort of an increasingly untenable proposition as the rescheduling process between the banks and countries was really working, right? Because the debt problems were deep, and then we had this case.
Because basically, the fund was then saying you'd have to either pay these arrears back, or you have to clear the arrears, or you have to restructure the arrears before we are able to come in.
That's correct. And by restructuring, I mean at that time, pretty much everyone meant rescheduling, right?
Right. Yeah.
This is what the banks were doing in the 80s, right? But it wasn't working. And then there was this case of Bolivia, where Bolivia basically was unable to reach agreement with its creditors because the problems were so deep that a rescheduling wasn't enough. And then, the fund that essentially prompted a rethinking. And in 1989, then the fund came up with the original lending into arrears policy. And that has remained more or less unchanged until now. Even our latest review is, I think, a more of an updating and a development than a fundamental change. And basically what the lending into arrears policy says is, yes, the fund can lend into arrears, provided that IMF financial support is really, really necessary, and provided that the debtor is undertaking appropriate policies, and in particular, negotiating in good faith with its credit. So it's trying to do something about it, basically.
And the lending into arrears is to maybe at this time in 1989 it was meaning all creditors, but then
no,
this is private creditors.
That's correct, because that was the relevant problem at the time.
Because it was we're talking about the banks back then.
Exactly. But it was not limited. I mean, you're right. Originally, it was targeted to the banks. Then in the course of the 90s, there were some adjustments which made clear that it applies to all private creditors, including bondholders. But we only had a lending into arrears policy for private creditors because that was, if you like, the problem, the obstacle, restructuring with respect to private creditors. And also, not to forget, private creditors do not own the IMF. I mean, this is sort of like
right. So you basically are saying, as the fund, we can come up with this workaround so that we can continue to help you, sovereign in distress, while you're sorting out or not paying your bank.
Exactly. Whereas lending into arrears to official creditors is kind of trickier because
that's tricky because you have a member country that's representative that says, "Hey, wait a minute."
Well, they sit on our board. I mean, these tend to be the rich and powerful countries. They don't like it if we lend into arrears, right? So that came much later. So basically, for a long time, from 1989 until 2015, we only had a lending into arrears policy.
Until 2015? All that time.
Until 2015, we only had a lending into arrears policy with respect to arrears to private, right?
Okay.
And it basically said what I just said. And the problem with this policy, what often irritated private creditors, is this good faith standard, right? So what is good faith? How do you measure it? And so we have a bunch of criteria, but they tended to be procedural criteria. And, the bar was pretty low. I mean, Argentina and the Kirchner defaults, right? It is a pretty low bar. We did end up lending to Argentina in arrears. And clearly, there were private creditors that argued that Argentina is not acting in particularly good faith at the time, right?
Mm-hmm.
But we had our procedural criteria. And I mean, broadly, the idea of this good faith standard is to say, look, we do think it's as important that debtors live up to the contractual obligations. We don't want to destroy the sovereign debt market, but just saying it's fine to default.
Right.
But we nevertheless, in extremis, are going to lend to you if you default,
right,
provided you are sort of more or less playing by the rules of the game.
Yeah, because you're still the fund, and you're supposed to be stabilizing the whole system. And if a member country falls over, your mandate is to kind of help them.
Yeah. So from an economist's point of view, it was sort of like a compromise between, a tough ex-ante principle and some exposed flexibility to deal with the situation. Right. Anyway, so that was the LIOA,
that's the LIA. Yeah.
The LIA policy. Then in 2015, something changed. Actually, in 2014, something changed. And, that's become relevant again. So, Russia kind of attacked Ukraine, got Crimea and supported, separatists in the Donbass and so forth. And in that context, Ukraine required a debt restructuring. So they got into trouble. They asked the fund, economic trouble. They asked the fund for help. We concluded they needed a debt restructuring because debt was unsustainable. We can only lend to countries with sustainable debts. And the problem was that Russia owned a bond, a Ukrainian bond. And so basically they held out. They didn't want to.
But they had restructured their debt and kind of created it as a bond, correct? Or
that's right. That's right. Yes. So they didn't want to restructure this bond, but I think that actually the fact that there was a bond, I don't think was relevant. I may be wrong on this. I'm supposed to speak for the fund here, but don't worry, they will disavow me if I make any mistakes.
Well, you're leaving anyway.
Yeah, exactly. So anyway, so the problem was that in effect, at that point we could not lend it to arrears to official creditors. And Russia had a bond. It was the sole owner of this bond. It was clearly an official creditor, and they didn't want to restructure. And so this would have held up the entire restructuring operation. And so in this setting, the fund changed its policy against the objection of Russia, but otherwise the executive board was on board. And basically what then became called the lending into official arrears policy says, we can, again, in extremis, if the member really, really needs our help, lend into arrears to official creditors also, but under certain criteria. And so one criterion is when the Paris Club holds a majority of the official claims, and then we sort of can ignore the rest. And the Paris Club decides to restructure, then we sort of can ignore the rest. That's the first condition.
That used to be the kind of standard kind of operating procedure in some way.
Exactly. I mean, yeah, exactly.
Like basically, if you had the Paris Club's agreement, you could move forward, and you could assume that comparability of treatment was going to be applied to kind of other, at those times, minor official creditors.
Precisely. So this first criterion, as you sort of imply, is no longer very relevant because the Paris Club these days very rarely has the majority of the official bilateral claims. Then the second circumstance when we can lend into arrears to official creditors seems obvious, which is if they consent, if they don't mind. They tell us, look, we're not ready to restructure, but we are fine with you lending into arrears. Now, interestingly, so that sounds completely innocuous, but this actually has become very controversial very recently. And the reason is that some non-Paris Club creditors, in the recent case of Suriname, China, and India, they didn't want to restructure. at least not yet. But we were sort of forced to help Suriname, and we sort of, the whole thing got delayed by 6 to 9 months because of this impasse. And so we originally couldn't go forward with this program because they weren't yet in arrears, so the arrears process didn't apply. Then, when a country has unsustainable debt and there are a significant amount of official debt involved, we require something called specific and credible financing assurances, which means basically debt restructuring assurances, in order to be able to go ahead and lend. And we weren't getting those. And so in the end, for that reason, we couldn't lend. And eventually Suriname fell into arrears. And once they were in arrears, the lending into official arrears policies gave us a hook to go ahead and lend, because at that point, the Paris Club did give us these assurances. But China didn't, and neither did India. But both China and India consented to us lending into official arrears. And then we went ahead.
So basically, they just say, well, we're not ready to restructure. We're just going to wait. You guys can go ahead.
And particularly,
we'll just accumulate arrears and deal with them later.
Right. And one of the reasons they wanted to wait is because they want to make sure that the private creditors would restructure, right? So that was part of their argument, if you like. And so we then went and lent into arrears. Now, you can imagine the Paris Club creditors were not very happy about this, because
because you don't have the private creditors on board yet, and your biggest bilateral creditors aren't on board yet.
Right. So they weren't. The Paris Club wasn't so worried about the private creditors, because that's sort of a routine situation, and the Paris Club has a lot of faith in its comparability of treatment requirement. But they clearly thought that, if non-Paris Club creditors can simply consent to lending into arrears, then this sort of basically lowers the incentive for them to actually come up and participate in restructuring. So there was sort of this question, well, are they trying to be holdouts or not? And sort of we made the argument, no, probably not, because, the program can be structured in a way that basically where it goes off track if the debtors that didn't want to restructure get paid, but the others don't. And so in the end, we went ahead, and we could, because the lending into arrears policy explicitly allows us. But this is clearly a little bit of an issue in the future, because it can basically weaken the incentives for official creditors to give us restructuring assurances ex ante.
Now, as an aside, well, there's two things I wanted to, but on that point right there, is there a requirement in some way to make sure that sovereigns or official creditors who have allowed the lending into official arrears policy to be triggered, and to say that, okay, well, we're going to wait? Is there any mechanism that the IMF then or other policy that they say that, they have to make sure that actually happens at some?
There are two IMF policies that are pertinent here, outside the arrears policy. The first one is that we generally do not, or we never take a position on the perimeter of the debt restructuring. So we, the IMF's role in debt restructuring is this game where we're trying to, it's a bit like a referee in a sense, right? You try not to interfere with the game, right? So you try lay out certain rules, but you try to get out of the way when the ball comes flying through the field, right? And so we try not to get hit by the ball. And so we basically do not try to be prescriptive on what debts and at what terms the debtor has to restructure. We say, look, this is up to a negotiation between you and your creditors. And if you are going to be kind of mean and put all the burden on one class of creditors and ignore the rest, then probably it won't work, right? So we encourage you to,
But at the same time, you're also kind of setting indirectly kind of how much debt relief, at least in total, needs to happen through the debt sustainability analysis.
That's right. This is the second principle, right? So the second principle is, while we try not to interfere with the debt perimeter, we cannot lend to a country with unsustainable debt unless the debt is going to be, unless we can be quite sure, confident that the debt is sustainable prospectively, meaning that there is a successful debt restructuring before the end of the program period, right? So that is sort of the iron rule.
Well, and just again, to be clear, that's because you're a lender and your mandate is that you have to be paid back, right? So
exactly.
The DSA is actually an analysis for the IMF to ensure that the IMF is going to be able to be paid back.
Exactly. So we are not an international bankruptcy court. We have zero statutory powers. The whole power, if you like, derives from this fact that people want us to lend in these emergency situations. And so we cannot do it unless we're pretty sure that the emergency is going to be resolved in a way that restores debt sustainability, right? And so this then gets to your question of whether we have mechanisms to make sure that in the end, everyone pays their fair share. So the answer is no, we do not have direct mechanisms. However, when we come up with a debt sustainability analysis, right? So the thing that goes into the appendix of the staff report on Suriname, for example, we are making assumptions on how deep this restructuring will be, right? Because this thing shows Suriname's debt to be prospectively sustainable. And so, if we are not sure that, in fact, Suriname's on track to renegotiate debt with its creditors along the lines that we have assumed, we have to immediately stop the program. I mean, we have to check this in every review, right? So every 6 months we have to check this. And so basically we decided to lend to Suriname because we had sufficient confidence that although China and India had not committed to restructuring, they had given us sort of friendly noises that they, would restructuring once the private sector restructuring was underway or completed. And we were sufficiently confident that the restructuring would actually happen within the program period to conclude that debt is sustainable. So remember,
and presumably at comparable terms. So you not only did you know it was going to happen, but you had some sort of inkling that it was going to happen and deliver the needed response.
The sustainability analysis, I mean, we only look for the bottom line, right? But in the sustainability analysis, we knew at that point what the Paris Club had offered, and so when we concluded that, probably debt is sustainable, yes, we made the assumption that this would be broadly on comparable terms, right? Now, do we have an instrument to enforce it? Not really, except that we will have to let the program go off track unless the restructuring happens. And then the question really was, will China and India have sufficient incentives to actually do the restructuring? And in this case, basically, we concluded, and this might be a case-by-case decision, so it's not clear that because this was the answer in Suriname, it needs to be the answer in other cases, that yes, this is probably the case. And the reason is that if they don't restructure within the program period, it's really not clear they will get their money back, right? That was the argument. So the chances of sort of playing a successful holdout strategy beyond the program period were deemed to be quite low. And the reason for that is that basically Suriname would not have a great incentive of repaying them in full or on better terms than the other creditors, given that at that point, they have restored normal creditor-debtor relationships with the remaining creditors, and so they would have access to finance, right? And so in that sense, they would be in a relatively strong position, meaning.
So in that case, you had financing assurances from the Paris Club, and you had some sort of, maybe not totally credible and specific, but you had, some sort of assurances from China and India saying, we will do this, and you had a high level of, confidence that that would actually take place because of the whole framework.
But just to be clear, our high level of confidence that this would actually happen wasn't just based on the friendly noises that China and India made. It was based on our assessment that in this specific case, Suriname, it was in the best interests of China to actually agree to a restructuring, because otherwise the chances would be quite high that they would be left out in the cold, essentially. That was the argument. And that may not apply to other countries, right? So this is important. So now we got off track. Oh yeah. So the reason I was going through these three settings where we can lend into official arrears. The first one is there's a Paris Club deal, and they own the majority of official claims. The second one is the creditor's consent, and one example where we just did lend into arrears on the basis of creditor consent was Suriname. And then the third one is sort of the really famous one that was created to deal with Russia in the case of Ukraine, and that is that we can actually lend in cases when there is no representative Paris Club agreement, there is no consent from the creditor. We might still be able to lend if it's really important to lend, if the country is dealing in good faith with the holdout creditor, and importantly, if by lending we are not undermining the financing from the official sector for IMF programs more generally. So in other words, in some sense, we can afford to upset a specific holdout creditor by lending into arrears, because we will still be able to get official bilateral co-financing for our programs going forward, right? So in some sense, the creditor that we are upsetting is not necessarily systemic or unlikely to react in a way that would put our whole financing approach at risk. That was the so essentially the calculus was, sometimes we can be tough and just essentially treat an official holdout exactly like we would treat a private holdout.
Right.
But probably we have to be a little bit careful, because if that official holdout is like a super important systemic creditor, then it's probably a bad idea.
you gotta choose the circumstances.
Exactly. So these are the famous three criteria, and so that was the justification for actually then lending to Ukraine, even though they were in arrears to Russia, and they continue to be in arrears to Russia. So that's the LIOA. And then maybe just let me say one sentence on the non-toleration policy to multilateral creditors or IFIs. So basically, if you like, this is the residual group where the original non-toleration policy still applies. So we generally do not lend to countries that have arrears to multilateral creditors, and unless there is sort of what we call a credible plan, or even better, an agreed plan to clear those arrears.
So that's getting into the kind of realm of what Sudan just went through, or Zimbabwe.
Well, in a case like Zimbabwe, it's correct that Sudan is a HIPIC case, which was doing great until, unfortunately, the political situation deteriorated. Zimbabwe is a case that has arrears to multilaterals, and indeed we cannot lend under our non-toleration policy to Zimbabwe unless there's a credible plan to clear those arrears. Indeed, and these HIPIC transactions typically start by clearing arrears to multilateral, including, of course, to us, but also to other multilaterals. So that is the non-toleration policy. The trick about the non-toleration policies to multilaterals is, of course, the question: what is a multilateral?
This was actually a case or an issue that came up in a case that we worked on quite extensively, the Gambia, which we stumbled upon this whole new categorization of that was being tried on. This was kind of pre-COVID of plurilateral, of just what is a multilateral.
Exactly. Exactly. So this was actually one of the main reasons to review this policy, because our definition wasn't very clear on this, and it's still not fully clear on this for reasons that I can explain. But it gives us a better hook now to solve this problem. I mean, roughly what has happened, I would say in the last 15 years maybe, is that we've always had a whole bunch of sort of small IFIs where it was unclear whether they should be considered multilaterals under our arrears policies or not. But, we have had additional institutions sort of enter this market. And of course, there is an issue. This raises an issue, first for the sovereign debt market as a whole, but specifically for our arrears policy, right? For the sovereign debt market as a whole.
Who exactly is a multilateral, and like what are the criteria in terms of the membership and their lending practices and the like?
Right. I mean, for you, the people that you might advise, if you advise, actually, regardless of whether you advise creditors or debtors, the problem with multilaterals is they claim, maybe for good reason, preferred creditor status. And so if a very high proportion of debt is owed to such multilaterals, it makes debt really difficult to restructure, right? Because basically you have to impose some exorbitant haircuts on the non-preferred creditors, and that makes everyone unhappy, and it may lead to protracted standoffs, litigation, and so forth. And sort of from the IMF perspective, we have sort of an analogous problem, which is if everyone is a multilateral, and in the end, our members are in arrears to those multilaterals, it really restricts our ability to help them, right? And so it dilutes, if you like, the non-toleration policy to multilaterals if you have lots and lots of institutions that claim to be multilateral with veto power, in effect, over IMF programs. And so
right.
We have an institutional interest to take a relatively narrow view of who is a multilateral. And so how do we take that view? What is the view that we should be taking? So under the old policy, the one that we have just reviewed,
mm-hmm.
We didn't have a definition. We basically, it was a judgment call, but there were sort of three factors that we were supposed to look at as part of this judgment call. The first is global rather than regional membership. So global membership basically pretty much automatically makes you a multilateral, right? So this is like institutions that have memberships that resemble that of the IMF, right? So if more than 50% of the IMF's voting shares or more than half of the IMF members, that sort of makes you global. So these are like institutions like the Inter-American Development Bank, the European Bank for Reconstruction and Development, the Asian Development Bank, the African Development Bank, more recently, the Asian Infrastructure Development Bank, and a few more, right? So those were it's always clear these are multilaterals. But then, there are other institutions that do not have global membership. So when do we consider those to be multilateral? So we had two additional factors. One is how the Paris Club has treated you as an institution in the past. So whether the Paris Club in effect recognized the institution as a multilateral that deserved preferred creditor status. And then finally, the treatment of the institution under the HIPIC initiative. So basically, the idea was if these institutions were good citizens under HIPIC, in the sense that they collaborated.
And more specifically, I assume what you're meaning is the Multilateral Debt Relief Initiative, the MDRI.
Yes. Yes. Well, the reference was explicitly to HIPIC, but you're right. It includes that. So if an institution sort of was part of this restructuring, then we would basically say, look, you were a good citizen in the past, so we will treat you like multilateral. The problem is that HIPIC is now, 20 years.
I was just going to say, there's maybe these institutions came about after HIPIC.
Exactly. And then the Paris Club, of course, hasn't had so many treatments
Right.
also for a substantial period. And so basically this definition became increasingly impractical. And so what we kind of propose, so the sort of the key idea, like good bureaucrats, we decided let's just punt and sort of defer to someone else. And so what we said is, in effect, look, if there is an official bilateral creditor committee in a specific debt restructuring case, right? This debt restructuring case that we are confronted with. And that official bilateral creditor committee is based on what we call a representative standing forum, which currently is only the Paris Club, but maybe in the future could be some other forum that has the same sort of international legitimacy as the Paris Club, and that would be then determined in the future. So if we have, in effect, a legitimate official bilateral creditor committee, then we are just going to take our cues from what is a multilateral from that committee. So we are going to follow the evolving official bilateral creditor consensus on which institutions deserve to be called.
So in other words, and another way to look at it is it'll be your member countries and your board members really who are going to then ultimately make a decision of saying, well, yeah, this one is in the club. They're, like you say, a good citizen.
Yeah, not ad hoc, but sort of. Look, the idea was the beauty of in a sense showing deference to what the official bilateral creditors think is that the official bilateral creditors they internalize exactly the type of trade-off that we have to deal with. So on the one hand, official bilateral creditors do not like having too many multilaterals around, because that also increases the losses.
No, because they're not sharing the burden if you're giving them preferred creditor status.
On the other hand, official bilateral creditors tend to be the shareholders of these multilaterals and tend to have an incentive to protect them. And so basically we just pump the decision to these creditors committees. So basically what we ended up doing, I don't know, I'm going to just go ahead and tell you what the new policy is. Okay?
Yeah. No,
we
sorry.
can get back to the letting into arrears and stuff. Okay, so basically what we ended up doing is we went through a few kind of iterations on this one, because as you may infer or assume, suspect, this was the single most controversial part of our policy review. So basically what happened was we wanted a very clean, the staff sort of proposed a very sort of clean, ex ante precise definition of multilateral creditors, where we would effectively put in IFIs. By the way, in order to be a multilateral, you have to be an IFI, right? If you're not an IFI, you're not a multilateral. So multilateral is a smaller concept, a tighter concept than IFI. IFI means an institution that has at least 2 sovereign members and no non-sovereign member, right? So basically the idea that is in the paper, which is published, is let's put the IFIs into 2 classes. We have sort of an A list and a B list, if you like. The A list are these global multilaterals, plus we also thought that regional financing arrangements and other institutions that have sort of a essential role in the global financial safety net, that they also should be in this list, because they are sort of like the fund, right? They have a similar mandate like the fund, and so it's in our interest to protect them because we want them to help us resolve financial crises, right? So we have basically kind of this list of institutions that either because their membership looks like the fund, or because their mandate looks like the fund, or has some elements that makes them close, makes them very key players in the global financial safety net. Those institutions, we said, look, here we really are sure. We don't need to ask them.
So those are, and just to be clear, not to like single anyone out, but that's like, okay, so the IMF, the World Bank, kind of the regional development banks.
That's right, including the AIIB, which is a global membership according to our definition,
right,
but also the regional financing arrangements, the ESM, the FLAR, the Chiang Mai Multilateralization Initiative. So those institutions, and God forbid that this would ever happen, an institution like the ECB, basically a reserve currency central bank that has members from different countries. And so they might actually acquire external claims that, God forbid, might at some point lead to arrears. And so an institution like that sort of has a critical role in regional financial
stability. Okay, so that's the A class.
That was the A. And then for everyone else, we said, look, for everyone else, we are just going to do what just going to follow the consensus of the official bilateral credit.
On a case-by-case basis.
On a case-by-case basis, unless in a specific case, we don't have an official bilateral creditor committee, right? Could be based on a representative standing forum. Maybe there's no committee. Maybe they're not. Maybe because there aren't enough official claims in a particular restructuring case. But at the same time, there's still a multilateral that has claims that are in arrears. So it could always be that we don't actually get any guidance in a specific case from an official bilateral creditor committee based on a representative standing forum. And in that case, we would then go into the past and look at treatment and a HIPIC and Paris Club and so forth. But the idea was, whenever we can, we just look at these official bilateral creditor treatment. So that's the proposal in the paper. Now, basically, this proposal made a few institutions intensely unhappy.
I can imagine.
Those were the institutions that sort of were part of the B list, if you like. But they felt that they were very important to the, at least, global development finance world, and that this sort of A-list, B-list approach was in effect discriminatory. And so it was clear that because of these complaints by these institutions, our board was divided and on whether this was the right approach. And at the fund, we don't like divided boards, right? So we sometimes push through decisions against one or two members, but generally we try to operate by consensus. And so basically we went back and say, okay. And so what we ended up is with a compromise between the current policy and that policy that's in the paper. And the way we did it is we eliminated this A-B divide. So there's just one category right now. And instead, what we did is we took the new elements of our proposal, namely that it matters, your mandate matters, and the views of the official bilateral creditor committees matters. And we simply added those two elements, new elements, to the existing factors that we're supposed to consider when deciding whether an institution is a multilateral. So now we have effectively something that looks like the old policy, which is it's a judgment call where we look at several factors. And these factors still include the current ones, the old ones, namely membership, Paris Club treatment, HIPIC participation, but then there are two new ones. And the two new ones are, if you're part of the global financial safety net, that makes you more likely to be a multilateral. And if the official bilateral creditors think that you are a multilateral, then you're also probably a multilateral. So we threw it all in. And so what this does is, and it was very controversial because some of our members really liked the staff proposal and they liked the precision of it. And so in the end, we told them, look, in practice, it's not such a big difference, because in practice, what we're going to do is if it's a global institution, that's pretty much a sufficient condition to be a multilateral. If it's an RFA, or if you have a critical role in the global financial safety net, that's also, we, the staff, are going to treat it as a sufficient condition to call you multilateral. But generally, if an official bilateral creditor committee thinks that you're not a multilateral, we, the staff, will also pay a lot of attention to that. So the only difference really to the policy that's in the paper is that we are allowing ourselves and the board a little bit of wiggle room to not automatically disqualify an institution from multilateral because some
in that determination, do you also consider, there are certain cases where there's not a lot of other debt, right? So a lot of the debt of some of the lower income countries is very heavily to these both kind of your A and B list kind of institutions. And so if they have to go through a debt restructuring, if all of them are excluded from restructuring, yes, what's left is actually, you almost have to write it all off. Is there something along those lines that also has to go into the calculus of who has to participate?
So not explicitly, but implicitly, this comes in through the determination of the official bilateral creditor committee, right? So if we are in a case where a large share of claims are held by IFIs, and hopefully not all of these IFIs are the African Development Bank and the World Bank,
right?
Then presumably the official bilateral creditors will, in their own interest, decide that the smaller IFIs maybe should participate in the restructuring. And then we would follow the official bilateral creditor.
Okay. So, and this revised policy gives you the ability to have that conversation, whereas in the old one, they could always just say, well, we're a multilateral development bank.
Exactly. Precisely. The problem with the old one was that it was so imprecise that, because we are also so obsessed with even-handedness, that we ended up even though we didn't have to under the policy, there's a lot of pressure to then say, okay, everyone's a multilateral. And so the new policy gives us a hook to say, no, hold on.
Well, exactly.
One that may not interest your viewers so much because, I have your listeners, I'm sorry, you have, of course, lots of private creditors that I'm sure are listening to this. And so we haven't talked about the changes to the LIA. First of all, they're not dramatic. But I think they are sort of clearly for the better, and I think also the majority of private creditors would think that they are for the better. So let me start with what I think is arguably the most important one, even though we have to say that the transparency maybe is the most important one, but maybe from the perspective of your listeners, the most important one is that we, in the past, the good faith criterion was really overwhelmingly procedural, right? And that led to, so if you engage with creditors, you negotiate, you engage with creditor committees, at least in complex restructuring cases and stuff, you go through the motions. And so basically the private creditors were like, okay, guys, what you call good faith means they invite us to a cup of tea and then they send us home, basically, right? That's not good. And so basically in the new policy, we are putting more emphasis on the actual substance of the debt restructuring offer, right? So basically what we are saying is that we expect the debtor, in order to qualify as good faith negotiation, we expect the debtor to make a restructuring offer which is quote unquote consistent with the parameters of the IMF supported program, end quote, okay? So what does this mean? It means that you're supposed to make an offer that is likely, that has a good shot at restoring debt sustainability. And that excludes, that's my interpretation at least, that would exclude two extremes. One is where you basically promise the moon to the creditor and we know you can't keep it, right? So if you promise more than what we think you can afford, if you promise something that might not be consistent with that sustainability, we're not going to go ahead and lend. But the other extreme is also relevant, which is if you make some ridiculous lowball offer to your creditors, and it's clear that they're going to reject that, that's not good faith. Okay, so in some sense, we're taking on board this long-standing criticism by creditors that said, look, you got to, in defining good faith, you need to look at the substance of the offer, not just its procedure. So we have listened to this. Now, I suspect that there's still quite a big range of offers that we will call as being made in good faith. So private creditors are not going to be completely happy, but at least this principle is being acknowledged. So this is one important thing.
I can see where your referee comment earlier comes into play, and that you are then kind of stepping in to some degree to say, okay, this is in line with our analysis, and this is a reasonable offer within striking distance, right?
That's correct. And so maybe you're saying, we're a bit more prescriptive than we used to be. In this case, perhaps in ways that the creditors are going to be more sympathetic with, because on the other side, it was always the case that if the restructuring is inconsistent with debt sustainability, we wouldn't go ahead and lend. But remember, this is all still justified by only one idea, which is we want to be reasonably confident that debt sustainability is restored within the program period. I mean, remember that when we lend into arrears, we're taking a huge gamble, right? Because the debt situation is unresolved and it might just not resolve itself. And so we're taking this leap of faith and saying, look, if the LIA criteria are satisfied, this gives us sufficient confidence that actually they're going to agree on something that restores.
We can move forward.
And that's a really big leap of faith. And so if we have a debtor that kind of goes rogue and simply doesn't make an offer that has the remote chance of being accepted, then that should raise a red flag, right?
Then you say, well, wait a minute, we're not going to lend into this arrears situation. Like, you guys aren't serious.
I think this was always the case, but we never wrote this into the policy, and now we have it in the policy. So this is one thing. Then the other thing is, in the old policy, we had an information sharing requirement. And basically that says that the debtor should please share, quote, relevant non-confidential information.
Mm-hmm.
And we got rid of this non-confidential thing.
Mm-hmm.
And the reason why we got rid of it was twofold. First, the reason it was intended was actually it was understood under the old policy in a very narrow sense, and people didn't always realize it. It was supposed to mean market sensitive. And so basically we put this non-confidential in because if not, we would have run the risk that by requiring the sharing of market-sensitive information, we might be forcing a debtor to run afoul some securities law. That was essentially the idea.
Right.
And so the setup, the kind of thinking under the current policy is that there are two types of information. There's sort of confidential, the market-sensitive stuff, and then there's relevant but non-confidential. The relevant and non-confidential should be shared in any case, whereas the confidential stuff, that was the old thinking, should be shared, but only in the context of what we call a formal negotiating framework. And what that means is essentially a creditor committee whose members are sworn to secrecy. That's what it meant. So the idea is... And
then there's procedures for them curing those and all of that.
Exactly. And basically, again, this was because we felt that this information has to be shared, but we have to do it in a way that is consistent with securities laws and blah, blah, blah. And so basically what the private creditors that we engaged with in the run-up to this change, we had many conversations with all kinds of stakeholders, including private creditors, and they basically told them, look, this worry that you need to distinguish between market-sensitive and non-market-sensitive, and the IMF has to sort of design its arrears policies to make this distinction, it's kind of all unnecessary because we can handle this. I mean, we can make sure that communication flows in a way and the other thing they hated was that, when there is a creditor committee, our original thinking was the confidential and market sensitive information should be shared with the creditor committee. Now, this is fine as long as the creditor committee consists of sort of buy and hold investors, maybe banks, that don't actually want to trade during the restructuring process.
But those creditors are less and less.
Exactly. So if you have hedge funds in there, for example, they want to trade all the time. And so they didn't want to be put in a position where, because market sensitive information is only shared in this creditor committee context, they couldn't be members of the creditor committee and trade at the same time. So basically what the private creditors told us is, look, just get out of this business of trying to sort of, in a sense, help private creditors deal with sensitivity, because we can do this ourselves. And in the meantime, they were also telling us that because not everyone understood that what we meant by non-confidential information was non-market sensitive information, in effect, they were seeing signs of abuse of our policy by some debtors who were saying, oh, the IMF is telling us we're not supposed to share confidential
this. Right.
And everything is confidential. Of course, they have a different standard of confidentiality. So we basically just deleted the words non-confidential.
So you basically said, okay, now share whatever you want, and you and the committee can figure it out.
Whatever is relevant, share. And now the question is, what is relevant, right? So, of course, we cannot force debtors or creditors, for that matter, to disclose contractual terms that, might truly be commercially sensitive, whatever that is. But what we can have is a pretty exhaustive list of things that we consider to be relevant and that should be shared. And we have that list in the paper now, right? And so that includes essentially just anything that you need to get a comprehensive picture of the debt stock, including creditor composition, instrument composition, the basic information on financial terms, upcoming debt service, and whether you have collateralized debt or not. So these are things that we feel should be shared.
Now, one of the things that private creditors are also always complaining about is that they actually want to see the DSA. They want to see the funds analysis, and not just the template. They actually want, the filled in template. Is that part of this, or is that a fight for tomorrow?
Okay, so this requires a very nuanced answer. I mean, first of all, my perception is not that they just want to see the DSA. They want to actually write the DSA. So, well,
I think what they want is they want to know what you're using for the basis of your analysis, and that they can then have their own copy where they can change the assumptions and the toggles and say, well, wait a minute, we think the picture is going to be rosier, or we have a different view on how this is going to play out.
Okay, so we have two answers for that. The first one is they can actually see the DSA. So, and the reason is that the DSA is published in the staff report when we go to the board to lend, and we would, in an ongoing restructuring case, we would typically go to the board before the negotiations are concluded. So they, before they sign on the dotted line, they see the DSA. And to the extent that they need some information on debt sustainability before the whole staff report and DSA are published, we would not do. So we wouldn't give them the DSA at that point, because the DSA is essentially predicated on a macroeconomic framework that the country needs to have committed to, right? And so we cannot produce a DSA before all the I's are dotted and T's are crossed, and that is at the moment when we send a program to the board. But we can have informal conversations on debt sustainability with the creditor. So there is a practical way around, sort of a sequence of steps where the private creditors are told not just what the IMF thinks is the minimum debt relief that is needed to make that country sustainable, the so-called debt relief envelope, but they're also told how we arrive at that conclusion, because that is published in a staff report before the restructuring concludes, right? So that's we have always done that. And of course, we are very happy to then have calls, explain in the DSA. I was in such calls myself, and sometimes they were painful. In actually a very unusual case when we did a DSA, even though we didn't have a program, which was the famous or infamous March 2020 DSA we did for Argentina, right? And we usually don't do that. And in fact, some of our board members were really unhappy we did this, and it may not be repeated. And the reason is, we should typically do a DSA because we need to check whether our own conditions for lending are satisfied. That's our justification for doing a DSA. It's not that we want to play God. Now, in the case of Argentina, it was just such a difficult situation because they clearly needed our help. But for political reasons, coming out of this awful political and economic mess where we were basically accused of financing the campaign indirectly of the candidate that just lost, it was just impossible to negotiate a program at short notice with that government. We have done it in the meantime, right? But at that point, it was, and they were running out of money, so they were about to default, and they wanted to restructure. So they told us, can you please help us restructure, except by any means, except for a program. And we sort of said, okay, we'll do it. We'll do it sort of the DSA as a technical assistance exercise. And then we published this DSA. And then that DSA was the basis for the Argentina August 2020 restructuring. And I think it was successful, right? In the sense that, the creditors went right to the very limit, or maybe slightly above the limit of what we had said was the maximum that Argentina could afford in that DSA. And so we had lots of calls to explain to them. So I think it's generally not true if creditors claim that we don't show the DSA or we don't explain it. But clearly what private creditors sometimes don't like is they view the DSA as is being dictated by the fund, right? So we come up with our DSA and it's like a take it or leave it thing. And what they want very often, and I understand that position, is to negotiate the DSA with us.
I think what they have trouble with is that the IMF runs their DSA. They have all of these discussions with the sovereign. They come up with, as you say, the envelope. Then, the kind of traditional order is then the official creditors come in and they do their thing. And then it's just kind of like, hey, private creditors, this is what you have to do. We've decided it, kind of now go kind of implement it. And they rightfully, I think, have a point of saying, well, we'd like to be in the process earlier, especially when in so many cases, they're so important. And as we've seen with, lots and lots of cases, that we need their participation and their participation early. And so it's tricky. I don't know there's no real easy answer to any of this.
Let's put it, let me make 2 points. First, obviously we have lots of discussions with the Paris Club, but the official creditors do not influence our DSA either. So the DSA is something that is done by the IMF and only by the IMF, albeit based on a macroeconomic framework that is negotiated with the debtor country. And so in that sense, yes, there's an asymmetry in the sense that the DSA is based on a negotiation with the debtor, but it is not based on negotiations with creditors, right? So this asymmetry it's correct to say this is asymmetry. Now, is this unfair? I don't think so. And the reason is our definition of debt sustainability. So basically what we view debt to be sustainable when debt can be repaid conditional on what we call politically and economically feasible adjustment.
Right, exactly.
And so the question is, which is the old capacity to pay question, right?
Right.
So it's not true that sovereigns, that's where we started from in this conversation, have infinite capacity to pay because they have the power to tax. But certainly the power to tax gives them a lot of scope for adjustment.
Yeah, the basics is, okay, a country's having problems. You're going to have to change your ways. You're going to have to adapt to whatever the circumstances are. But depending on what's caused the problem or how it's come about, you might not be able to completely shut down your country and like change your entire budget and everything else. That's not reasonable to ask. So under reasonable adjustments, you and things still don't add up, you're going to have to go to your creditors and say, sorry, guys.
That's right. And so this is the one area where we really are in a unique situation. And this is, of course, the reason why we are often really unpopular with civil society, debtor advocates, and so forth, that we ultimately have to make the call on what we think is feasible adjustment. So this is the whole business of why the IMF is associated with austerity policies.
Right. This is all the conditionalities, right? This is what you say. Well, yeah, we'll lend in, but you're going to have to rethink these subsidies, or you're going to have to rethink this tax policy, or you're going to have to rethink, whatever.
Precisely. And when we make the call of whether a particular tax hike or an expenditure cut, whether it meets this definition of feasible adjustment, we basically just talk to the debtors and try to get a sense. And sometimes we talk to third parties like political scientists, experts about this country, but we do not talk to the private creditors or to the official creditors either. Why not? Because they're interested parties, of course. The debtor is an interested party too, right? They may moan and say, oh, we can't raise this tax. It would immediately get the government voted out of office. So in cases like that, we have to be critical and not believe everything that we hear. And historically, I think we have been rather critical, which is why we are often accused of being sort of advocates of austerity. But of course, the private creditors think that in some cases, and I agree with them that sometimes they may be right. In some cases, we should have been tougher. We should be tougher, right? And so what the private creditors would like is they would like to sit at a table, and when the debtor says, "Oh, we can't do this policy because it's too tough," they want to blow the whistle. Essentially, they don't trust us to be sort of the arbiter of what is feasible or not. But this is a line we cannot cross. So we cannot let them into that particular negotiating room. We cannot have a conversation about adjustment that then immediately boils down to a negotiation between the private creditor and the because otherwise we why have us there at all?
Well, I'll get some private creditors on the podcast and we'll get them on the record and hear what.
If you're unhappy, private creditors, don't write to me, write to my successor. Okay, so
I'm conscious of time, but have we touched on all of the major?
Well, the one thing we haven't talked about two things. One is the preemptive policy, preemptive restructurings, and the other one is this definition of official direct bilateral claim. So let me just say one quick thing about each, because they are actually both important. So one of the weird things about these arrears policies is that the fund really didn't have a policy in the past of when to lend in unsustainable debt cases where there is a restructuring going on, but there are no arrears, perhaps no arrears yet. So we had all this elaborate internal procedures, policies for lending into arrears, but arguably that's the situation we're trying to avoid, right? And we didn't really have a policy.
At the same time, you have oodles and oodles of research that says, in fact, you should act early as a sovereign. Sovereigns kind of heading into distress should act early, should sit down with creditors early, kind of be preemptive, proactive, etc. But that wasn't covered.
That wasn't covered. It was covered, but it was covered by one sentence. And the sentence is, this sentence is, there are two sentences, one for private creditors, one for official creditors. For private creditors, the sentence is, the fund can lend into unsustainable debt when there are no arrears yet, and hopefully never, but there is a so-called credible process for restoring debt sustainability. So basically, when you have a case where clearly the country is insolvent, it recognizes that it has reached out to its creditors. In a case like that, even though debt is unsustainable, we can lend, but only if there is a credible process to address the unsustainability problem. And so what we didn't say in the past is what we mean by credible. We had some internal criteria. So we had a particular practice. And so basically these very concrete, very practical things, like, have you hired a financial advisor, right? You haven't? Well, call Jill or her competitors, right?
No, just call Jill.
Not Jill. But anyway, or have you hired legal advisors? No. Well, if you are going to be serious about a restructuring, you need a legal advisor. So these are sort of formal steps. Then, how do you engage with your creditors? Have you actually talked to them? Have you started the process, right? So these are all kind of practical things that we looked at in the past, but they were never written down on paper. And so basically what we have done now is to write this up to essentially just clarify how we think. Okay. And basically what it boils down to is a very similar set of criteria as the good faith, right? So in order to judge whether a credible process is underway, we will look at these procedural steps. We will look at whether you have engaged with creditors, but we also will look at the substance of your offer. So if your offer is kind of ridiculous in either direction, we are not going to go ahead because we don't think this will work, right? So that's what now called the policy for preemptive restructuring cases. And by the way, one important thing in this policy, just like in the reformed lending into arrears policy, is sort of an increased emphasis on debt transparency. So, have you supplied, or are you willing to supply, relevant information about the terms of your debt stock, creditor composition, and so forth? People who know the IMF, like you and others in the markets who frequently engage in restructurings, for them it's not a big surprise what we have here, but I think these things often look very black boxy from the outside, and so we are just sort of letting people take a peek into the black box. Basically, that's what it is. Right? It's also an attempt to be more transparent on our side. Okay, and then the last thing that we did, and this was truly sort of a reaction to events, is we have these situations in recent years where official entities like central banks, for example, buy a ton of bonds, right? And so then the question is, suppose that a country goes insolvent, right? So this might not be terribly relevant if your own central bank has bought your bonds because they're part of the general government, and so it's sort of left pocket, right pocket thing. But suppose you have a central bank of, for example, a currency union that buys the bonds of a member, and then that member goes into arrears. Then the question is, do we treat that bond purchased in the secondary market as an official claim under our arrears policy? So that warrants, if you like, the protection of the arrears policy, meaning that the official creditor can basically hold up an IMF program unless the conditions of some arrears the official arrears policy, for example, are met, or in the case if the credit is a multilateral, as would be the case if this is a reserve currency union central bank or just a currency union central bank that buys these claims, then we might not be able to lend at all because that's the non-toleration policy, right? We do not tolerate arrears. So basically what the view we took here is the following, that if you have a situation where an official creditor owns the entire bond series, we treat these as official claims, and the reason is that by paying deference to these claims, we're not holding up a restructuring with the remaining creditors, and particularly with private creditors that are typically, most of the creditors, they're the bondholders, right? However, when these are bonds, when the same bond is held by the private sector, and these are vote pooled claims, so the restructuring depends on what some majority or perhaps even unanimity of mechanics of that, then we cannot treat one bondholder differently from the other bondholders, and in particular, we cannot give deference to the official creditor and apply a non-toleration policy to the claims that are held by that creditor, because by doing that, we are making the restructuring of the entire bond series impossible. And so what we do in that case is we stop calling them direct bilateral claims and or official claims, and then basically we apply the lending into arrears policies to all the bonds, even those that are held by central banks or other official creditors. Okay, so for the purpose of these vote pool claims, we treat all creditors, regardless of who has bought the bond, as under the lending into arrears policy. And this was a bit hard.
And that meaning the private creditors, the LIA ones, right? So in other words, so let me just repeat this back to you. So if there are sovereign bonds and they have CACs or other sort of, like you say, some other sort of mechanisms within them, then anyone who holds those bonds are going to be treated more or less like a private creditor under those policies. However, if another sovereign has such a bond without those provisions, or if it's 100% owned, the series is 100% owned by an official creditor, then in that case, it can be an official sector holding it and treated as such.
That's correct. That's correct. So if an official creditor owns an entire bond series,
then they can control it and it can be treated
exactly.
as a right.
We treat that like a bilateral loan.
Right.
It's the same.
And they say, okay, well, that's it. It looks like a bond, but it's going to act like something else.
Yeah, and the reason is we're not impeding the restructuring of the other bonds by doing
right.
that. But if we have these bonds that are part of a series that is also held by private creditors, then if we, you see, it doesn't have to be CACs, right? I mean, if they're
just
pooled,
any sort of right pooled.
Yeah, because you see, imagine there are no CACs,
right?
And imagine there is an official creditor that buys one bond, and then the country gets into debt problems, needs to restructure. Basically, and the IMF says, let's take an extreme case where the conditions of the NTP or the official arrears policies are not satisfied. So we really say, unless you have a credible plan to repay that particular creditor, we are not going to.
No, I see. And then that would hold up everybody, because they would be like, well, wait a minute. And I mean, I don't know if you want to say or you don't want to say, but is this come about because of the Greece or other countries where, the ECB or ESM? Is this really about that?
Our policy still would allow the ECB to do something to extricate itself by doing what it did in Greece, right? So what we would be saying is that, look, if you have bought these claims and the private sector also has bought these claims, then we are going to treat your claims under the lending into arrears policy. So we would then, as long as the debtor is negotiating good faith and it is urgent and they're doing appropriate policies, we, the IMF, would tolerate arrears to an institution like the ECB. Now, in practice, of course, this is all completely absurd because the ECB is much more powerful in Europe than we are, right? So the fact that, the bargaining power of a euro area member vis-a-vis the ECB is not influenced by what the IMF does, right?
No, that's just gonna.
Yeah, they're gonna have to deal with.
They're gonna just sort it out themselves over there.
They will sort it out. So this whole kind of premise is kind of absurd. But anyway, for the purpose of the argument, this is how it would work. Now, in actual fact, of course, it never came to the situation in Greece in the actual 2012 restructuring, because, as you know, sort of shortly before the restructuring, the ECB swapped the bonds that it held of Greece against bonds with a different ISIN number, identical payment terms.
Right.
Basically, they did a swap operation that ended up in the ECB being the sole owners of the bond series that it was owning. And then that enabled the restructuring with the private sector to proceed.
Right, and that could go forward without having to deal with them as a
exactly.
bond.
And so that operation would still be possible under our policy, right? So there's still this escape route, if you like. And the point, of course, is that in the meantime, the ECB has changed its policies, right? Under the OMT, it says that it would not insist on different treatment than the private sector, right? And so this is all kind of not practically relevant in my view. But what we are doing with these policies is we try to have really a complete set of guidelines that enables us to act whatever might happen.
And I think the whole point of this whole conversation is really that these policies have kind of practical implications, and they're having to be kind of revised, and a living institution that is constantly having to revise its rules and its approaches, and, like you say, trying to codify practices that have evolved kind of in parallel without being written down yet. So it's important to try to reflect that, but that it's always going to be a little bit messy and a little bit, kind of always going to be adapting to new situations that arise as they come.
Exactly. But this was a particularly tricky part of the paper. And just to recall, the paper also states, it doesn't mention the Eurosystem, but it does in a table, but not in the paper, but it does talk about reserve currency central banks. And I don't think there is more than one reserve currency reserve currency union central bank. So currency union banks that issue reserve currencies. Okay.
One always has to speak a little bit IMF speak and always read the footnotes, I've learned.
Exactly. So basically what we say in the paper is that if you are a reserve currency union central bank, meaning the Eurosystem, the ECB and its the members of the Eurosystem, then we are going to treat you as a member as a critical component of a global financial safety net, which is we count you as a multilateral creditor, right? Which means that in principle, because you are super special, you are protected. But we make an exception for claims that are bought in the secondary market and they are vote pooled. Those claims then, in a sense, are taken out of that because for the reasons that we have just explained. For all other purposes, the non-toleration policy applies.
Thank you so much, Jeromin, for your time and for walking us through these very intricate and very important policies of the IMF.
Very, very happy to do so. I mean, at the fund, particularly if you are dealing with these arcane matters, you're always very grateful for people who are willing to listen to you on this stuff because they're not too many.
You've been spending years on this, I know, and many working groups and I think it's incredibly important, and I know at least some of my listeners will listen to the end and be very happy to have this clarification. So thank you so much.
You're welcome.
Thanks for listening. If you enjoyed the episode, leave us a review and subscribe to the show wherever you get your podcasts.